Hey everyone, it's me, Tamara Celeste here from Sweet Life Realty Group. So I wanted to do this video because I've been receiving several phone calls from friends, family, clients, just about how high home prices are right now and how high they continue to go. Some people are a little reluctant to buy a home right now, whether to live in or for investment, because they believe a housing recession is imminent. Also because they think it's going to be a repeat of what happened in 2008. And people are feeling like they're just going to wait out the market, wait for the market to crash, prices to go down, and pick up themselves a deal. While I can understand why someone thinks this may be the case, because COVID-19 has caused such a disruption and has caused such a surge in the housing market, I just wanted to talk about 3 reasons why I believe this housing market is so different now from the housing market that caused the recession and the market crash back in 2008. And also, I don't believe we are going to see a drastic decline in the housing prices in the near future. So stay tuned. So, reason number 1 as to why I feel that this market is so different is because prior to the recession in 2008, individuals and households were so much more indebted and credit quality was so much lower. So, let me explain what I mean by that, okay? So, prior to the financial meltdown, the bar to entry to obtain a mortgage was very low. The joke in the industry was if you had a pulse, you could get a loan. For example, to qualify for a loan prior to the recession, your credit score could be minimal. If you didn't have enough income to qualify for a fixed rate mortgage, you could get an adjustable rate mortgage, or an ARM as it's called, with a lower payment in order to qualify for a loan. And at this time, it seemed like a good idea because at that time, borrowers thought, hey, we'll get this loan at the adjustable rate mortgage. And then we'll refinance it because prices keep going up. We'll refinance into a fixed rate. But then housing prices did not continue to go up, and it didn't materialize, and they were stuck with these adjustable rate mortgages that they couldn't afford, and people had no choice but to walk away. In addition, with housing prices rising, homeowners were taking out home equity lines of credit and refinancing their home to the max and pulling out equity. This was all happening prior to 2008. And even for investment property, you didn't have to use any of your own money in some cases. You could get an 80-20 loan, which meant that you would have 2 loans, one for 80% of the purchase price and a second loan for 20%, which represented what should have been your down payment. So all these factors, when the recession hit, a lot of people who bought these investment properties, they had little to no skin in the game. They just walked away. It was like, I'm done. It's not a primary residence. We didn't put a lot of money down. So it was just easy to walk away from all that. And that also helped to flood the market with all these foreclosures. So again, all that together, I believe, is what was tantamount to a house of cards almost. It was just like waiting to collapse because what was going on in the financial markets and the housing markets couldn't possibly sustain itself long term. So let's look forward to after 2008. Laws were enacted to protect consumers, credit tightened, the amounts of loans to borrowers was less than scores than 620 has shrunk significantly. Additionally, adjustable rate mortgages accounted for nearly 30% of loan applications before 2008. Now they're practically non-existent, especially for buyers that are purchasing their own home as a primary residence. I was just talking to one of my lending partners this week, actually, and lenders have even begun to tighten lending standards yet again in light of what's going on now in the housing market. For example, for investors in some cases are required to have a minimum score of 720 and put 25% down. So as a result of these types of credit conditions, it's less likely that a wave of foreclosures would occur at the same level that happened previously. So moving on to reason number 2, homeowners have equity again. Yay! So homeowners in 2020 have averaged about $69,000 in equity, and seller profits have increased as much as 90% in some housing markets. I have several clients that went under contract last summer to build a home that will be completed this year, some within the next couple of months. Many of you listening might be in that case. And many of them are walking into $50,000 to $75,000 worth of equity before they even close on their home. Home prices just keep going up. So what does that mean? That means that if someone isn't able to pay their mortgage now as opposed to 2008 due to a job loss or some other unforeseen circumstances, they now have the option to just sell it. They can sell it, they can pay off their bank, and they can walk away with some money in their pocket. And they can also go and rent or buy something smaller that's more affordable. Some people have also asked, well, what about all those landlords that aren't getting any rent right now, right? So I say the same thing about the landlords. They have the same equity. All of the prices are increasing, not just primary residents. So if the landlords feel like they aren't able to pay their mortgage, there are people with deeper pockets that are willing to step in, buy that property from them, and the landlord pays off their mortgage, walks away with some cash in their pocket. So I think that this applies both to primary, to second homes, and to investment properties. So that is my second reason why I believe that it is not the same market. So now moving on to my third reason is now that banks are more prepared for any sort of downturn that would happen. The banks wouldn't flood the market again with foreclosures because it would only hurt them, their bottom line, and doing this would be shooting themselves in the foot. And the banks and financial institutions have a vested interest in keeping the markets as stable as possible. Also, I'm pretty sure they already have buyers lined up to buy large blocks of these foreclosures, which I'll talk about in a minute. So I got my real estate license at the end of 2005 and really started to focus on real estate in 2006 when things were starting to actually slow down. And let me tell you, when foreclosures started to happen by the thousands and then subsequently by the millions, the banks were so unprepared. I personally did hundreds and hundreds of short sales and negotiated them myself. And I remember when short sales first started becoming a big thing, the banks had no idea. They were just so overwhelmed that they pretty much would take any offer. I would submit an offer, they would send a realtor to do a drive-by and do some comps, and then pretty much accept what was on the table. They were just, it was crazy. So if you were fortunate enough to buy a home at that time, you were able to get some really, really good deals on homes. Well, let me tell you this. Those days are long gone. Banks are much, much more prepared. They have processes in place. Also, when the foreclosure moratorium ends, most of these properties will never ever hit the market. As we speak right now, hedge funds and large institutional investors are already negotiating with the banks to take them off the bank's books. These guys are waiting in the wings with millions and billions of dollars to swoop in and buy up portfolios. So the bank, for example, would say, hey guys, I have a portfolio of 10,000 homes. Will you take all of them for $100 million? I'm just making these numbers up, but you guys get the idea. These investors will gladly buy them up because they're buying them for pennies on the dollar, 50 cents on the dollar, 25 cents on the dollar. So these investors are going to take them, rent them out, and they're going to just wait for the market to increase. Or they'll continue to rent out the homes because the rental market is so strong that they will reap the rewards of the income from all these rentals. So if there is a downturn, the average person will probably never, ever even see the majority of these homes that are going to go into foreclosure. So now these are just my opinions. Please let me know what you think. And please feel free to reach out because I love talking about real estate and answering questions and, just going through different things that are happening in the market. I hope this has been helpful and has given you some things to think about when you are thinking about buying or selling a home. And I will have more videos coming out soon. So please, my number will be on the screen. Please reach out. If you want to talk about your home, if you want to talk about buying investment property, call me, email me, anything. And I will see you in the next video. Bye.